We also had a great weekend this weekend. I had a couple of guys come into town. I went to Chicago, cut downtown. I ran into Terry Duffy. I hadn't seen Terry in a long time. When I walked up on him, he was having, Terry Duffy is chairman of the CME group, CEO of the CME group. He's the one that took the CME group public. When I walked up on him, Terry and I have been good friends for many years. I hadn't seen him in a while, or his wife, Jen. When I walked up on him, I don't think he recognized me at first. I had to actually introduce myself, but we ended up having a really good conversation. And my conversation with Terry is actually what kind of, feeds into what I wanted to discuss a little bit tonight. We were just kind of getting caught up on the state of the world, right? The state of the commodities world, the state of the world. And asked what I was doing. He knows I'm still trading, but asked, what I've got going. And I kind of, besides the PAX group, I've got other things in the works and talked about that. Maybe we'll get to a little bit of that tonight, but it was interesting. He said, you really should look at developing and starting an HFT, a high frequency trading model. I recoiled. I really did. Terry's a great guy. He's very smart and he's got the inside track, right? He knows. He knows. And maybe 10 years ago, maybe not 10 years ago, you guys, I think most of you are by now familiar with my story or part of it anyway. After MF Global failed in 2011, and after a series of other events that led up to it, it was the straw that broke the camel's back. And me and my wife were literally overnight, I had a couple $1 million in my trading account. Within 6 months, I had, started to just throw piles and piles of money into my futures account while we're waiting for MF Global to sort out, just blowing through hundreds of thousands of dollars at a crack, trading the S&P or actually NASDAQ more often then. And we started to look for nickels and quarters and dimes. I had all 5 of my kids that weekend. I've got 2 older kids from my first marriage. And then we had 3 younger kids who were young, real young at the time. 15, 14, and 11 now. They were probably, 6, 4, and 1. We needed change to buy milk for our kids. Here I am, living in the lap of luxury in Lake Forest with very expensive cars. And we're digging through those very expensive cars to look for actual nickels, quarters, and dimes so that we can buy milk. We had food in the house, but it was a Saturday afternoon. We were debit our checking account. And I'm telling the story for a reason, not to glorify anything that I've done, but, we literally look for nickels, quarters, and dimes so that I can buy milk for our kids. At that time, I think that I would have thought that HFTs were the way to go, only I just, I couldn't afford to build one. I had to wait until I found out what was going on with MF Global. So here I am during that time, pouring hundreds of thousands of dollars of cash into trading accounts, blowing through it, trying to make back that money. Well, no idea what's going on. Until I emptied out my account, I went to the head of RCG at the time, Scott Gordon, who was an old CEO of the exchange that Terry took over for. Spoke to him about only putting $5,000 in my account so that I can learn how to trade properly. I went from 100 lot packs to 1 lot packs to 2 lot packs. I had to develop something that's very important, right? I had to develop a trading process. It was important. It was imperative. I absolutely had to develop this process. We all need to have a way of looking at the market, visualizing the market so that we can take action in it. But more importantly, I had to develop a process outside of my trading that was going to keep me from living in my fear. For those of you guys who have listened to my first podcast that I did with Credelli a few years back, Anthony asked me what the hardest thing for me to deal with in my trading was. And without hesitation, I answered accepting success. I don't think he expected that answer, but I started to make a lot of money and I did not know how to deal with it. Negative thoughts and my self-talk didn't change. My self-perception, my perception of who I was ultimately didn't change. All that changed was that I've got a lot of zeros in my bank account. I was making more money than I could possibly imagine. I went from $250 in my trading account, and after about 6 months of trading in the late 90s, and actually in the fall and winter of 97 going into 98, to making a $500,000 my second 6 months, my second full 6 months, because the NASDAQ was $100 a tick. You know, I was taught two things by two great mentors, Mickey Opp and Jug Hershberg, both of them. I could not have become a trader without a successful trader without either one of them. One taught me how to look at the market, visualize it, trade it. The other one taught me how to be and fight and battle like a trader and survive like a trader, to understand what my fears were and to overcome my fears. Because fear, as I tweeted this morning, fear, and this is what I want to talk about tonight, fear is going to kill us. Fear is the #1 killer of all traders, fear. So my fear of being successful at that time started to creep in. You know, my marriage was deteriorating, and things were getting hard there, right? Things were becoming more difficult. And so it's always interesting to see how many people are going to leave when I start talking about things like this, because, you know, it's interesting. People want to hear, you know, how I trade and where I buy them and sell them. They want me to tell them where to buy them and sell them. And that's important. But if that's what you're looking for as your answer, you're in deep trouble. Speaking of which, where are we? Oh, all right, do me a favor. You know, stop where I am about fear. Write down, and we'll come back to this. Write down the reopens in the equity markets. Okay, the S&P futures open at 42.38.5. Write it down and circle it. NASDAQ open at 13,991. Everybody in our group will know why that level is significant, and it was significant long before it became significant on other charts. All right, so 13,991. Russell 2332. 2332. Also write down crude 70.65. That's significant. All right, so write down those openings, the weekly reopens, and also Bitcoin if you want to, if you guys are into Bitcoin. 38,900. Okay, 38,900. So I'll get back to the prices in a minute, but what I wanted to talk a little bit about was, more than a little bit, was about fear. And, you know, as patterns in the market change, so do we, you know, as our careers evolve and change, we evolve and change too. What my fears were early on in my career, they're not my fears now. I'm not afraid of success. I'm not afraid of the market. I'm not afraid of at all about what the market can do. I've got no fear of the market. I've got no fear of what the market can do to me. I got no fear really ultimately of what I can do to myself. I've got different stopgaps in place to protect me from me. You know, my wife was a clerk on the floor for 18 years. My wife, you know, maintains my accounts. So if I start falling, I don't know what my P&L is from day. I mean, I have an idea, of course, but I don't know. She knows to the dollar amount. I don't, you know, that's part of it. She'll come and grab me. I'm accountable to my partner. So my fear is, and these last few months with my health issues, this last one, this is why we haven't done a video in May or, you know, even the first couple of weeks of June, was because I've got a new health issue caused by the old ones. Panuveitis, which is inflammation of the inner eye. It's, you know, arrested right now, but it was bad for a month. They were terrible. Anyway, the whole thing is, you know, I haven't really traded since March, and even then, you know, it wasn't much. All right. Anyway, my fears nowadays harken back to those days. You know, harken back to my wife and I looking for nickels, quarters, and dimes. I don't need to rebuild anything. I've already done that. I've already built my trading process. We can talk about that tonight too, if you'd like. But I wanted to talk about the importance of what my process is to get inside of my process, because that's important, and how I maintain that, because that's how I stay out of destroying myself. Like Andrew said, very glad to hear you talk about this topic. Understanding fear and our responses to absolutely. It is absolutely, you're absolutely right, Andrew. It is the absolute 100% golden nugget trading. This is it. If there is a secret, I can give you all kinds of enumerated things, and I'll talk about the 3 rules of engagement, the 4 pillars of capital management. I'll talk about the 2 types or the 2 parts to every trade. And I'll talk about the most important parts of all of those things. But guys, if we don't get a grip on who we are and what our fears are, none of it matters. None of it matters. Oh, I wrote down a good line about that. Fear-based trading will always, without exception, destroy our careers. Everybody in my group will hear me talk about, everybody in my group will hear me talk about being confident, carefree, fearless, and focused, or CCFF for short. Confident, carefree, fearless, and focused. Confident, carefree, fearless, and focused is my morning checklist. That's what I do. I wake up, I go through the same routine. I wake up at the same time every morning. I make my bed. I do the same thing every morning. I do, the same breathing exercises, same yoga, same stretching. Well, not same, but different every day. Meditating, prayer. Sometimes a guided meditation, sometimes prayer. And then I get my coffee. Then I come downstairs. First thing I do is I make my bed, if I didn't mention that. Then I go through everything else. Just every day, it's the same thing. It's my process to get inside of my process. It takes me, I'm older, I'm a morning person. It takes me a good 2 hours to get into the right framework to trade, the right mind frame to trade. It takes me at least 2 hours. I need to go through this morning routine, this morning process every day so that I can determine if I'm confident, carefree, fearless, and focused. Because what's the importance of that? If I've slept well, if I ate well the night before, if I've exercised, if I've got a good plan for the day, I go grab my coffee, I come down, I check the market, I look at my plan, I make the necessary adjustment to my plan. The last thing I do is I shower, I sing, I dance, and then I come downstairs. I get the blood flowing in my body, right? So at that point, determining if I'm confident, carefree, fearless, and focused will help me determine my size. And this is the key, right? This is, like Andrew said, it's the golden nugget to trading is I need to know, and all of us need to know how to size up, how to size down, and how not to trade, how to go big, go small, or not at all. I said this on one of Quideli's TV shows, how to go big, go small, or not at all. That is it. Now, there's a few different ways of increasing size. And I don't want to get into this, but too far into it, but I can increase my size if I'm, we trade in quarters in my group. That's how I trade. And that's how I teach other, I teach other traders how to trade through my example. We trade in quarters. So if you're a 4-lot trader, you can increase your size by trading 8 lots. You can go ahead and trade an 8-lot, or you can trade a 4-lot and let the market dictate your trades. Increase your size when the market gets to X. But have that planned out ahead of time. If we get to X, I'm taking profit. If we get through X, I'm going to increase my size. Through the years on the screens, I've learned how to adapt to these high frequency trading models and their algorithms so that I can let them do the work that I used to do on the trading floor. I started off as a 1-2 lot trader in the NASDAQ when the NASDAQ was $100 a point, $100 a tick. It was every 1 lot was $100 a tick. I had $250 left in my account. I think it was, my daughter was born in June of 97. It was January of 98 when that happened. So it's going to go, yeah, for sure. It was January of 98 when I had just barely nothing left. My seat lease was at that time $3,200 a month, $3,200. So every month, $3,200 came out of my account. Plus, I had the expense of having to pay for my mentors, both of them. I had the expense of having to pay for a clerk. I had the expense of having to pay for, the interest on the T-bill that was backing me. I had to make $5,000 every month just to break even. $5,000 every month just to break even. Oh, what the hell was the point of that? I lost my train of thought on why I was, how I got back. Oh, I started off trading 1 lots and 2 lots, and I learned on the trading floor how to allow the market to dictate my size. So as the volume in the NASDAQ grew, you can go back and look at a NASDAQ, CQG offers it, NASDAQ pit data. You can see that when I started trading in the NASDAQ, when we were $100 a tick, we only did like 5,000 contracts a day. I remember an old Deutsche Mark trader who came down, he was like my age then, so he was ancient. He came down into the NASDAQ pit. A lot of old currency guys came into the NASDAQ pit because the NAS traded like the currencies used to. And he said, boy, could you imagine, we were sitting by the out trade table. He said, could you imagine if we did 5,000 contracts a day in this market, we'd all be rich. I mean, not 5,000, 10,000. If we did 10,000 contracts a day, we'd all be rich. And boy, if that wasn't the case when it happened. So, you know, the more volume we did, the more open interest grew, the more active I became. You know, I grew with the market. I was in the right place at the right time with a modicum of talent with two wonderful mentors. So I made the most of it because I didn't have any fear. I wasn't afraid of the market yet. I wasn't afraid of being successful yet because I didn't know what that looked like. I wasn't afraid of anything. So all it was just blue skies ahead, man. It was down there every day. I went down there every day knowing I was going to make money. At that time, 1,000, 5, 2, 1, 10 if it was busy, all of that, right? Fast forward to rebuilding my career on the screen, you know, and then of course I become, you know, one of the bigger traders in the pit. And then in the hog pit, you know, I went in the hogs and rebuilt my career and, you know, had to keep my mouth shut and eat a lot of crow, and they didn't want me in there and they didn't like me in there, but, you know, I eventually earned their respect. So after MF Global, trying to intertwine the two, you know, phases of my career, and I call them two phases: on the floor, off the floor. So when I was trying to develop this process, I had to really understand what my fears were. And at that time, I had a lot of them. Oh my God, I had a ton of fears. Except I learned early on, and I think all of you have heard me tell this story about when I lost $1.5 million in, you know, in a Greenspan move, when Greenspan cut interest rates. Was it a cut? Yeah, Greenspan cut interest rates by 50 basis points on the first trading day of the year in 2001, I think. And I got caught short. I was the only big trader in there, and I got caught short a pretty good number, and I lost $1.5 million in like 30 seconds. $1.5 million I didn't have a year before that, 2 years before that. $1.5 million I never dreamed I'd have. And I was at work the next day. I was debit, but I was trading the next day. So that day is when I learned that I had nothing to fear from the market. The only fear I had was what I knew I could do to myself in it. I don't fear that anymore. I didn't fear it in 2011. What I feared was banks going under. I feared, you know, going to work again one day and having nothing there. So we have slowly, as I rebuilt my career, and I've learned how to let the market increase my size, as I was trying to say earlier, you know, and I've been learning how to develop a process within my process. I've learned that fear sort of, not sort of, but I've learned fear has absolutely no part in my trading. When it pops up, now I find myself doing one main thing: over trading. You know, I'll take too many attempts coming out of the opening range. I'll take too many attempts at one of my targets. I'll overtrade, you know, my plan, or I'll just simply throw my plan out. You know, and I mean, you know, has any of you guys had that experience? You know, I know a guy who had started his own he designed his own algorithm, and it was really it was successful. He ended up selling it. It was a guy that I clerked with. He was related to a major name on the floor. He's a cousin, and we used to tease him all the time about it. You know, he was from the suburbs, and he wanted to be from my neighborhood in the worst way. But anyway, he was really smart, and he developed this algorithm, but he could not trade. I heard Mark Douglas talking about this in a video not long ago, and I thought, holy cow, that's Jimmy P. You know, this friend of mine. He developed these algos, and he still does, but my God, he couldn't trade. You know, if the algo was short, he'd be long. And I really laughed out loud when I heard Mark Douglas talking about that. I've never read Mark Douglas's book. I read 93 pages of it. And one of the women in my group sent me his video, and I watched half of it. And it's really good. I laughed out loud in the beginning when he was talking about this Indian doctor who was just doing the same thing. He had this great method, but he couldn't trade because he threw his plan out the window. Plan schman, man, I know better. Now, you know, confident, carefree, fearless, and focused, I think not. Now it's ego. You know, for me, it becomes ego, whether it's and by ego, I mean, I'm not the greatest trader in the world. I'm not the new Warren Buffett. I mean this, I mean that, you know, I become involved in my trading. And this is what we talk a lot about. I get emotionally attached to a specific price. I get emotionally attached to a trade for whatever reason. Fear starts creeping in, fear of losing money, fear of whatever. And all of a sudden my plan goes out the window and I just start trading. I can have, and I did this a year or so ago, last summer. I ended up having like 20 round turns, 30 round turns in the middle of a day where we didn't even get to one of my pay lines. You know, I think we paid for the trade one time in the afternoon, and I'm clicking away because I'm getting emotionally involved in that trade. The big thing that I have to worry about with the one thing I have to pay attention to, and this is my ego, right? Is when I'm in the group, and I haven't really traded really since March, April, okay, but at the end of April, I got this uveitis, my eye felt like it was coming out of my head. You know, I do have vision problems. Now it's getting worse, but it's, you know, anyway. So the thing that I have to be on the alert of is I need to, you know, impress people in my group, right? Hey, PAX can't be, you know, if PAX isn't trading, I'm not trading, or if PAX isn't, no, you know, I'm not trying to create on Twitter or in the PAX group or, you know, anywhere else. I'm not trying to create a bunch of clones. I'm trying to help you guys become the best versions of you can possibly be, because if you're doing that, then you're choosing to live your most authentic self, and fear becomes known. It's become identifiable. And when fear becomes identifiable, then we can deal with it. When our fears, when you can name what your fears are, when you know what your fears are, then we can start to work around them. You don't necessarily have to know what they are. You don't have to necessarily know what they are, but you do have to know that they're there. No, you do have to know that what they are. You don't have to know the why of it, is what I mean. You don't have to know, you know, well, I got to get at why it is, so that I don't need to understand all of it. I just need to know that it's there so that I can then work around it or protect myself from it. There's only two parts to every trade, managing your risk and managing your profit. What's the most important thing that we need to know about any trade? What is the only thing we need to know about any trade? The only thing that we need to know about any trade. We need to, right, absolutely, Olaf. Come on, you know the answer. We not just that, but we need to know our outs, plural. We need to know what our outs were. That was a Mickey Hoffman line. We need to know where we are. That is the only thing that we need to know in order to take a trade. Where am I going to get out if the market goes against me? Where am I going to go out if the market goes the way that I'm, you know, if it goes my way? I don't like saying that because I try to choose my words carefully. Going my way, it's not about me, right? I'm either on the wave of the market, you know, and I'll talk about that in a minute. The groundswell becomes a wave, right? How to recognize that, how to deal with it, how to trade it. I will get into the buying and selling of things, but I really do. I want to talk. I'm not, guys. I'm not a psychiatrist. You know, I'm not a obviously, shit. I studied philosophy, and I'm not even a philosopher, and theology, and I'm not a theologian. I'm just a trader, you know, who has the benefit of his experience. And not only do I have the benefit of my experience, and I've got notebooks and notebooks and notebooks full of stuff going back to the late 90s, but I've got the benefit of the experience of guys that used to clear my firm, of traders that I used to back. And by guys, to be clear, that is my word of being all inclusive. Okay, so let me just try to rephrase that. You know, people that I cleared through that cleared through my firm, or that I had backed, or that I had just been with and listened to and asked questions of. Okay, yeah, David, it's being recorded. You know, I've got that benefit of those experiences and those people, and I would ask questions and talk to them. You know, like when I walked onto the trading floor, I didn't know a soul, not one person. I came on the floor. My friend Frankie Bologna got me a job as a runner. I made $89 a week. That's what I cleared. It was like $120, $110. I made it. $89 was my first check. And within a month, I had a job as a trade checker in lumber. But I'll never forget walking around. It was in January of '88, not long after the crash, and the markets were dead except for the Eurodollars. They were still busy. I ran orders in lumber and the back month euros. And I'll tell you, as you guys have heard many other floor traders say, You don't need me to say, but when I walked onto the floor, I thought, oh my God, I was intimidated. I was really intimidated, but I wanted to know what it was going on here. And I knew that I now found what I wanted to do. I was like 20 years old. But my God, I knew what I wanted to do now. And so I did everything I could to make that happen. One of them is I would ask questions. I would meet guys. You know, I met Ira Harris, and I would say, good morning, Ira. You know, I've said this before, right? Or Harry the Hat. Good morning, Harry. That's somebody that I used to say hi to all the time. And Harry would growl at me. You know, people would carry hat, would walk on the floor, and people would like part ways like he was Moses. I would be standing right there, you know, like a pain in the ass. Good morning, Harry. Eventually, you know, he has a good day. He's walking on the floor. He's in a good mood. And so he says hi back to me. Now he's got to look down and see what my name is. Now I'm developing a kind of a rapport with these guys. So as time goes on, they're kind of used to seeing me around. They're used to me being part of the fabric of the floor. And as I moved up, right, I got my membership, I start asking traders questions, brokers questions, traders questions. And sometimes they'd answer, sometimes they wouldn't. You've all heard me talk about this. I don't know how you guys do it on Twitter. I really don't, because I see a lot of traders that'll say, you know, some really cool things, and all the, you know, on Twitter and fin Twitter, whatever they call it. And maybe they're just ripping off another guy or another girl or whatever. And it's just become, I don't know. How do you tell who's real and who's not? It's very difficult. But when we're, when you do find somebody real, I mean, and that resonates with you, stick to it, because very rarely are you going to find anybody that's got true, real experience. And I mean it, true, real experience. It was interesting to be, I was the other night at Chicago Cut Steakhouse, and then the following night with our wives. It was just a bunch of traders. It was just a couple of newer traders. Me, my friend Mike, who had been trading, God, Mike he was one of my clerks out back, and he had been trading for years, since I'm 24 years old, I'm 24 years trading. He's 22, I think. A lot of experience at that table, and also, you know, a lot of lack of experience, but together, you know, we had some incredible conversation about what it takes to be successful, which is why I wanted to do this conversation tonight. And then I had a long conversation with Adam yesterday, you know, which is just another, and some other traders that I talked to on the weekends that I do mentoring with and stuff. And you know, it just made me think that everybody is kind of dealing with the same thing. Everybody right now is dealing with fear. When the markets contract and the ranges contract, and they get kind of harder to trade, and this is the most difficult time to trade, in my opinion, is rollover is always the most difficult. Plus, it's going into the summer markets, quiet. You know, school is ending. People are going on their short little vacations. Markets are quiet. They're quiet. Plus, we're in front of the big FOMC two-day meeting on Wednesday, decision coming out. That can kick off some volatility. Now, as you've heard me say many times, you've heard Ira Harris saying many times, we have already entered into a period of a sustained very volatile market. So we're going to be very volatile, but we're going to also have these quiet cycles. When we have these quiet cycles, and all of a sudden fear comes out. Okay. When we start to find ourselves tying our you know, our sense of self-worth into our P&L, or we find ourselves kind of, you know, defining our moods even by how much money we made or lost, our plan stops mattering. We are no longer confident, carefree, fearless, and focused. You know, if I'm starting to define myself by how much money I made, or my mood is going to be dependent upon that, then I know one of two things, and people around me will know. I'm not going through my morning routine. I'm not going through my morning checklist. Maybe I woke up an hour later and I'm still making it work, or whatever. I didn't sleep well, or whatever, and I'm still getting in there. Now, I still trade after I don't sleep well. I still trade when I don't feel well. I still trade when I got things on my mind, when I might not be so carefree, when I might not be so focused. I still trade, but I cut my size. And it's something I call my 2x4, you know, the 2x4. I give myself 2 trades. If I don't find the momentum, I cut my size. After 2 trades, I cut my size. If after 4 trades I don't find the momentum, I put myself on the bench. Done. I need to protect myself. I need to protect myself. And if you guys are trying to, learn the opening range, it's just please, past results are not, indicative of future results or whatever, however that goes. But the point is don't trade live, trade it on the simulator, give yourself time. All of these things that I've said in previous videos, but because you've got to learn how not to chop yourself up. You've got to learn. I talked to Corey Gill this morning in a private message that, on Twitter, and, we talked about how to not chop up coming out of the opening range. I don't want to talk about that, but, if I'm not CCFF or fully CCFF, then I've got to cut my size, or I've just got to, even limit my whole day to just 2 trades. Now, I don't have to take those 2 trades by 8:40 or it's Chicago time. I don't have to take those trades by 10 o'clock. I can take it later on in the day, right? That's important to realize. I don't have to spend my 2x4 first thing in the morning. I can give myself, all day long until I see something in the market. That's sticking to my plan. That's living in my lane, driving in my lane. I have rules, 2 rules and a bunch of guidelines. My 2 rules are use stops on every trade, and to pay for every trade, remove my risk. Okay. Which again, I'm talking about, I know I'm all over the place, but I'm trying to bring things together and try to throw a little bit of stories and history into it too, but make it interesting. But when we're looking at the 2 parts of every trade, managing risk, which is what we're talking about so far, and managing profit, the only things that we truly need to know in the markets are, where are our outs? Where are my outs? If I know exactly where my outs are, then I can take it. Now, in managing risk, I have 2 ways of defining it, right? In my mind, we've got either good trade definition or perfect trade definition. And I distinguish between the 2, good trade definition or perfect trade definition. All of these things help us be able to, we don't beat the algos, we don't beat the HFTs, but we use them. We let the HFTs do the work for us. If we can do these simple things that will keep us in our lane, no matter how complicated your trading is, no matter how many indicators you've got on your chart, hopefully when you're done with this, when you listen to me talk for a night, maybe you'll decide to simplify your trading and give it a shot to just learn how to trade the price action or whatever it is. However you trade, but just simplify it. But just do these simple little things, okay? Managing risk. I've got 2 types of trade definition, a risk definition, good or perfect. Good is I'm going to be long or short at my risk, at my stop. So if I want to be short at 24, if 24 is the bottom of the opening range, and I want to be short under 24, I want to be close as short. I want to be short as close to 24 as I possibly can. So again, if 24 is the bottom of the opening range and I want to be short underneath 24, I want to be short as close to it as possible. So 23.75, 23.5, because if the market goes back inside of the opening range, I'm getting out. There is good risk definition. Perfect risk definition would be, being short exactly at my stop, and that stop would get me out and reverse. There are different, and that's, you guys have heard me talk about, or maybe tweet about, how you increase your size without increasing your risk. There are multiple ways of doing that. And again, please don't do this live. Do it on the simulator. That's why I think the simulator is a great gift. It's like working out. It's important. Hold on, let me get some water. From nowhere. So, think of it that way. We've got good risk definition. We've got perfect risk definition. Perfect, just a quick example is, if I want to be at the top of the opening range, 24, bottom of the opening range is 24, top of the opening range, 26.5. In there, in between that, it's like a room. I don't want to have anything on inside that room. But if we get up to 26.5, the top of the opening range, we keep banging against it, we can't get above it. And this 24 to 26.5 is a big target for me already. Plus we opened up inside of it. That makes me want to trade this opening range. I don't want to trade every opening range, by the way. I don't trade every opening range. But let's just say that 24, 26.5 in this example is a target for me. Perfect trade definition is going to be me noticing that the market cannot get out of the opening range, keeps banging against the top of it. So I'm going to take a short at 26.5 because my stop is at 26.75. So I'll be out and long there. Okay, that's a really important thing. Now I take that short at 26.5. We come out of the bottom of the opening range at 24. Now I sell another unit. If I'm a 4-lot trader, I'm short 8. What's my risk? Anybody want to answer? My risk is I've got the risk of a 4-lot. Because I've got perfect trade definition at 26.5 and I've got good trade definition at 24. So now I'm short 8 and I've got the risk of a 4-lot. If the market goes 24 bid, I'm out of all of them. So the worst I can do is lock in 2 points or a point and a half, whatever that is. Does anybody have any questions about that? I didn't want to really get into too much mechanics, but that's just one point of it. So if I know my risk, and I can define it either good or perfect, fear has less of a place in my trading, doesn't it? Now I'm more confident. Now I'm more carefree. Now I'm more fully confident, more fully carefree, more fully fearless, more fully focused. And now I'm starting to recognize the price action and not my P&L. I'm starting to trade the price action and not my P&L because I can define my risk. Okay, now to the second part of a trade, which is managing our profit. And you guys have all heard me talk about, if you guys have any questions, please, listen, as I've said before in previous videos, man, I can drone on and on. I can literally drone on and on for hours. And ask my wife, my poor suffering wife, or my kids, God forbid. I think one of my daughters was here and I saw her leave within 5 minutes. My oldest daughter was just finished grad school at the University of Iowa. I've got them from 25 down to 11. Anyway, so the second part of every trade is managing our profit. That goes to our plan, right? Before the market opens, I know that I'm going to do X if the market goes here. I'm going to do this if the market goes to X. I'm going to do that if the market goes to Y. I know what I'm going to do before the market gets there. I've already planned on it. And believe me, guys, I'm oversimplifying it, but it is simple. It is simple. Now, using that same example, 26 after 24, let's just say, because the market's rallying, I get long, and 24 to 26 half is one of those opening ranges that I want to trade because we're opening up in a major target area for me. Or, you guys who you profilers might call it, we're opening up where the market is in balance. And, we know that above here, the market's going to extend, or below here, the market's going to extend lower. Either way, or you're a wave or whatever floats your boat in trading, whatever helps you visualize the price action. Okay. So just to keep it simple for my purposes, the market opens up and my targets are defined by a lot of things and profile is part of it. I don't talk about this much, but I did trade under Pete Stottlemyre for a little bit of time in 2009, I think, or 10. I think Jim Dalton had funded it, but Pete Stottlemyre was trying to upgrade, or that's maybe not the right term, but update market profile to bring it into the age of algorithms. And it didn't work, but I'll tell you what, that was one of the most incredibly interesting experiences of my life. I felt like I'm not a dumb guy, but I'll tell you, I felt like a moron every time I sat and listened and thought he's so smart. All right. Anyway, now back to this example. The first part is managing risk. Second part, managing our profit. By the way, let me get there too. There are different sorts of traders. There's the traders that are the roller coaster traders. You're making 10,000, you'll lose 20, and you do it consistently. You're consistently putting money into your trading account, right? You're on the roller coaster. You have not learned how to manage your risk. for whatever reason, for whatever fear, you're trading the P&L, you're allowing your fears to control everything. You're freezing up, you're throwing whatever, you're throwing your plan out the window, whatever it is. You have not learned how to manage your risk. Traders that are breaking even, and I think that this is, the longest phase that most of us spend. Traders that break even, you make and lose the same 10,000 or 20,000 for a year. You've learned how to manage your risk, but you've not learned how to manage your profit. That takes a lot of time. And again, this is another really big reason why 90+% of us fail. Out of every 100 traders, 90+% of us are going to fail. 9 of us will be somewhat, break even to somewhat profitable. And only 1 of us out of 100 will be ultimately profitable. Only 1 of us. Those are daunting statistics, but they are real. Now, anybody who tells you that this is, back to my conversation with Terry, anybody who tells you that trading futures, that we can't do this, that it's impossible for retail traders, or what we used to call local traders or independent traders, anybody that tells you it's impossible is wrong. Now, it's incredibly difficult, and the odds are way against you, and they're against me. Even though I've been trading 24 years, they're still against me. Many things can go wrong. Most of it in my control, some of it not. Right? Okay. Incredibly difficult, but possible. And I'll get to that. I'm getting to that now. Okay. See how I hope, my God, I hope in my mind, I think I'm tying things together, and I hope that I am tying things together. Okay. If I'm not tying things together and I'm still all over the place, somebody let me know. But if things are starting to come together a bit, then ask questions. So you've got the roller coaster trader, you've got the break-even trader, then you've got the profitable trader. Then beyond the profitable trader, you have the ultimately profitable trader. The ultimately profitable trader has learned, going back to the 4 pillars of capital management that we've talked a lot about before. Number 1 on every single trade, right? The first 2. Now, listen, you can write this down if you want to, but the 4 pillars of capital management, the first 2 have to deal with managing our risk. The first 2 have to manage our risk, okay? The second 2 have to manage our profit. Thank you, Carlos. Thank you, Carlos. Okay, so listen, so managing our risk, right? Number 1, the 4 pillars of capital management. Number 1, minimize our risk. How do I do that? Now, this is, oh boy, this can be tricky. You won't blow up any more accounts, but you can, if you don't learn how to do the other 3 well enough, you'll die death by 1,000 paper cuts, right? All right, so number 1 is minimizing our risk. How do I do that? In the same example, 26.5, 24, the opening range. I'm long at 20, and remember, I don't trade every opening range. This one, is an important one, so I will. I'm long at 26.5 or 26.75. The market gets a point, it goes a point, higher. The market is now protecting me. Okay. I minimize my risk by putting in a stop just inside the opening range. And this brings me to another really important reason, another really important point on how we manage our risk, and also how our fears dissipate. Our fears continue to become less and less a part of our trading when we learn how to minimize our risk. Number 1 of the 4 pillars, we minimize our risk. And number 2, if you want to write them down, minimize our risk. Number 2, remove our risk, and yes, it's possible. Number 3, maximize our profit. Number 4, exploit our profit. Okay, so number 1, minimize risk. Number 2, remove risk. Number 3, maximize profit. Number 4, minimize profit. All right. So back to that example, I'm long 26.5s or 26.75s. The market gets a point in my favor, and it doesn't matter how busy it is, right? The market goes a point in my favor. I'm going to put a stop, a hard stop. This is when I put in a hard stop. And this is that tricky part that you have to practice. And, and work on it. If you've got, I think, what is it, Trade-A-Bait that does, you can do the replay, some of the front ends, you can go back and replay, an opening range or a target, trading out of an important level for you. I call them targets, an important level of supported resistance, whatever. Targets work for me, whatever terms work for you, right? So now back to it. Get above 26.7, long 26.75. Market goes 27.75 bid. I'm talking about the S&P. If I'm talking about crude, it's going to be, like 3 or 4, 5 cents. So in crude, 5 cents. The NASDAQ, I don't trade the NASDAQ too often, but the NASDAQ would be 3 or 4 points. I don't trade the NASDAQ anymore because I fear that I know the market too well, and I have a tendency to get too stubborn in it. So the way that I deal with that fear is I just don't trade it very often, unless I see something completely obvious, and then I'll take the trade. But because I know the most important part of any trade, right, is I know my outs. As long as I know my outs and I can define my risk, I can take the trade. Doesn't matter what market it is. All right, so I minimize my risk by putting in a hard stop, because now the market protects me. I put in a hard stop just inside the opening range. One of the things that you guys will notice if you actually pay attention, I don't know how much you want me to talk about the actual opening range trading, the ORB, the way that I trade it, or if you just want me to continue along, using examples from my own trading so that you can, learn management skills. If you want me to talk more about it, let me know. But, the way that I think of it is the opening range is, as I said earlier, is like a room. If the market gets back inside the opening range, I don't want to have anything on. Flat ski fast too. So market protects me by a point. I put in a hard stop. That's it, right inside the opening range. Because one thing that you guys are going to notice is the algos and the HFTs are using the very same opening range that we used on the trading floor the first 30 seconds of the day. The opening range, take a look at the volume tomorrow morning in the S&P, NASDAQ, any market actually, at the regular trading hour open. You're going to see the algos kick their volume up. You're going to see the action in the market kick really, really fast. Okay, so it's going to go from like 700 contracts to, depending how busy the market is, up to 5,000 in that first 30 seconds. So just to real quick, there's an opening range and a closing range every day. The closing range is the last 30 seconds of the day, starting at 2:59 and 30 seconds. Okay, that's when the MOCs. You guys are familiar with that term, I'm guessing. All right, so Sherry, we'll talk about that. That's why I asked you about the earlier on. I asked you about the reopen Sunday night to write them down. Okay, so we'll talk about that in a second. Let me think about where I was so I don't lose my train of thought here. I'll do that too a million times. All right, back to the 4 pillars of capital management. All right, in the context of the opening range, since you guys like it. So MOCs are market on close. Market on close. That's too much. There are, just as our opening range strategies, there are closing range strategies. I can tell you stories about what we used to, how they used to be filled on the floor, and I don't know how they're filled now outside of just watching the price action in the last 30 seconds of the day. And you guys watch that, because you'll see, we'll go in the last minute. I don't look at minute charts. Okay, I don't look at charts actually during the trading day hardly at all anyway. I trade off the dome, so I'm looking at the price action. I already know what I'm going to do. If the market gets up to 42.41, I know I'll be, well, we're above that. Market gets up to 42.82, I know I'll be taking profit there. And if I've got nothing on up there, I know that I might probably take a short up there, even though I don't ever fade markets. Oh God, now I'm getting too far into the weeds. Back to the 4 pillars of capital management. Don't fade markets either. People that fade markets, I don't know. I know a lot of traders have made a lot of money doing it, but I don't know too many people that have kept it. It takes a real skill to be able to fade markets effectively and long term anyway, and real discipline. Some people have that discipline. I don't. I don't have that kind of discipline. I don't. I need to wake up every morning and do the same thing day in and day out, day in and day out, so that I can keep my process, going, so that I can keep fear away from my trading, so that I can be confident, carefree, fearless, and focused. And I'm going to be confident, carefree, fearless, and focused when I give myself the proper risk definition. When I've got proper risk definition, now it's on to the second part of the 4 pillars, which is removing my risk. And yes, it's possible. So I remove my risk is there's the way that I visualize the market, the way that I see the market moving is the way that I, the HFTs and the algos do it. And yes, it adjusts, and I've adjusted it through the years. But like, let's just stick to this example of 26.5, 24 opening range. Now, whether this is the S&P or crude or bonds or gold or whatever market you like to trade, it doesn't matter, or a stock. Sorry for the candy, my throat's getting dry. It's the same general idea works, and as long as you employ it, you'll be okay. So remember, I've only got 2 things that I do on every trade, only 2 hard and fast rules: stops and pay for my trade. So I let the market protect me. Once the market protects me, then I put a stop just inside of the opening range, because if the market gets back inside of the opening range, then that rally or break is over with. The market has gotten absolutely no certain. The market is just nothing but uncertainty, right? But as long as we're above 26.5, I want to be long. Below 24, I want to be short. And good risk definition versus perfect. All of those things we've gone over. So I protect myself, putting my stop in. Now I remove myself. I remove my risk by paying for my trade. And in every market, I have over the course of a long period of time determined what I call pay lines, and it's too much to go into here, but it's going to be where, and this is strange. It's a strange thing. You're not going to see this on charts. You're only going to see it live, but the pay lines become a form of intraday support and resistance. And any trader in our group will tell you that. And I know that some of you guys think, especially you technicians in here, are going to think I'm a wackadoo when I say that, but it's more often than not, it happens. The pay line in crude is going to be 20 cents. At 20 cents above the opening range. So in our case here, 26.5, it'll be 46.5 is going to be our pay line. We get up there, I'm going to sell 1. I'm long 4. Remember, my stop is at 26 inside the opening range. So in crude, I'm long at 26.5. We get up to 46.5. I sell 1. Now I have no risk. I've got 3 contracts still. I have absolutely no risk on it, because now my stop is either in the same spot, just inside the opening range. It's a break-even stop now for me, or I can raise it to a scratch. I don't normally do that because too often I'll get ticked out of a trade that ends up being good, because a lot of times you're going to see the market come back down, test the opening range after going to the pay line, come back down, test the opening range, not get back inside of it, but tick us out, and then ba-boom, they're up, $1, $2 in crude, 20, 30 points in the S&P. Oh, well, don't forget, the stops, the algos know exactly where your stops are. So that's why I try to keep my stops just inside of the opening range. Knowing all of these things help me deal with my fear, any fear, and help me stay focused on trading the price action and not my P&L. And I removed my P&L off my screens a long damn time ago. But when I am able to minimize my risk and remove my risk, and still now I have a free 3 lot on, and I cannot possibly lose money on this trade. Well, remember, stops can get run. There are the odd things that happen, but I will have a stop and I'll always be protected. But remember, guys, we have to. I don't have trading losses. How about this? How many of us want a trading method that has absolutely no losses? Everybody does. Nobody wants to take a loss. I don't take losses. I don't. Well, every so often I'll take a loss. And by loss, I define that by, something other than an expense. I know every single morning 2 things. I have no doubt that I'm going to be profitable by the end of the day. Now, that obviously doesn't always happen, but I believe it. I'm confident. The other thing I know is that I'm going to have to spend money in the market. I know it's semantics, but it's an important word. I've talked about this in previous videos. It's an important word because it helps me shift my mind to the price action, and it helps me rid myself of fear of being wrong. I don't like being wrong. You know, in this world, we all have opinions, right? We all have them. I don't like being wrong. Nobody likes to be wrong. Just a thing, right? I don't like being wrong in the market. I've got these targets. I'm PAX, you know, I have, you know, I'm a well-known trader. I don't want to be wrong. So I made that mind shift years ago that, that every morning I know that I'm going to have a reasonable amount of expenses in order to be able to help me find that groundswell that's coming out of the opening range that becomes a wave, and I'm going to catch that wave. I'm going to ride it to my next target. I'm going to let it see if that is going to continue to take me to the next target, you know, and crest, and the wave will dissipate. Okay, but I can't do that unless I remove my risk. Now I'm going to maximize my profit. How do I do that? I don't trade in the middle. I'm not going to trade anywhere unless it's already predetermined in my plan or part of my plan. I'm not going to trade anywhere unless it's part of my plan. I'm going to maximize my profit by not trading in the middle, by not trying to catch every little wiggle and the noise in the market and every little move. I'm not going to do it. I'm going to be long or short where I want to, where my risk is clearly defined, and I'm going to remove my risk, and then I'm going to take profit when the market gets to a certain period or to a certain price. And then number 4, I'm going to exploit that profit. That's a whole nother video. And this is what, I mean, I work with traders, and I mentor traders in a one-on-one setting and in a group setting. We have a group mentoring that meets twice a week. And all of us are in different areas, where all of us are in different places. Some of us are just learning how to stick to the 2x4 and not to overtrade. Some of us are learning how to increase our size by exploiting our profit. Okay, and it takes a while. It's, there's a real progression to becoming a consistently profitable trader and learning how to be an ultimately profitable trader. You just don't, just like, you're not going to strap on a pair of running shoes and run 26.2 miles in a marathon. You got to train for it. Same thing here. And at any time we can fall down and break our leg. It doesn't matter. I'm here to tell you, I've seen traders. I can't tell you. I cannot tell you how many traders I know that have, 20 who have had net worths of 10, 15, $20 million, $50 million that have gone broke. And every time I say that, I know that there are people that don't believe me. I'm telling you that I know countless traders that have had 20 to $50 million net worths that ended up completely broke. Because they're constantly they're not sticking to their plan. They're defining themselves by their fear. They're defining themselves by their ego. They're defining themselves by their P&L. They're not keeping things simple. Okay. 4 pillars of capital management. 4 pillars of capital management will stead capital preservation. Capital management will stead you well. Minimize your risk. Remove your risk. Maximize profit. Exploit profit by learning how to add at different targets, learning how to add to your positions without adding to or significantly adding to your risk or adding to your risk at all. Okay. It takes a long time. It is possible, and you can do it. I've done it a couple of times. Is there any questions so far? Or any things that you guys want me to go back to and explain a little more or flesh out? Or do I use do I use the same techniques for Globex Open? I guess I can talk about that now. So no, Sherry, the only time I'm going to pay attention to Globex Open, the only time I'll pay attention to Globex Open is on Sunday night You know, so on a weekly basis, if you guys, now obviously there's no price action now, but the S&P opened up at 42.38.5. Oh, that's something. Okay, 42.38.5 was the opening print. Now there's no opening range on the reopens. The opening range is only at regular trading hours. So like Bitcoin, for those of you that are trading Bitcoin futures or Bitcoin micros, the only thing that you can use in Bitcoin as something like that is going to be the Sunday night reopen. So I'll use the Sunday night reopen as kind of a weekly dividing line, you know. So above 38.5, I want to be long generally. Below it, I want to be short generally. Now, does that mean I'm going to take a long above it? Nope, it doesn't. There are the odd times where on Sunday nights I will. Monthly reopens, those are going to be huge because monthly reopens are going to play a part in how I target out the market. Quarterly reopens are going to be bigger. Those are going to be major quarterly targets for us, and also how I do my math to come up with our targets. And then expiration. So when the markets expire on Friday, when the equity indices expire on Friday, I'm going to generate a whole new target, list. And then, you know, and then we have the monthlies coming in another week or two. So these next few weeks are going to be important as far as that goes, Sherry. So, but no, I'm not generally going to do that, except for, again, I'll be mindful of what the weekly reopen is, because generally I want to be long above it or short below it. Or being taken profit there, or just being mindful of it. When we have a big move, we come back down to it, right? All right, so the next question is going to be, do I, yes, I do. No, I don't use bracket orders for breakout entry. No, I point and click, you know, so I've got my cursor and I've got my own little way, and I kind of teach that. I point and click to get in. I'm a point and click trader. I don't like using bracket orders. Well, just because I've gotten ticked out of things that I don't want to be ticked out of. I don't use trailing stops. You know, I don't use trailing stops because the market retraces back 5 or 6 points, and I'm getting, you know, remember I talked about minimizing or maximizing our profit. I don't want to I can't try to trade every wiggle. I can't try to trade every wiggle. I can't try to trade every move or the noise, or, you know, or I just can't try to trade that, you know, whether it's on an hourly or a 15-minute or, you know, whatever. I can only trade at my targets. And so I don't like using trailing stops, because the market can retrace back and forth between targets. And as long as I paid for my trade, and as long as I've taken profit at a target, and I still have 2 left. Now that's an important thing to say. So now I paid for my trade, I've taken profit. I'm satisfied with that right there. I'm going to let the market tell me what to do next. Now, the only way that I know what it's going to do is based off of my targets, one level to the next, as you guys have all heard me talk about. I see the market, visualize the market moving from target to target to target to target, like a ladder, rungs on a ladder, or from here to there to here, back to here, 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 right? But here I'm long, so it can go from here back and forth. As long as it doesn't get back into the opening range, I'll stay long. But, you know, target to target to target. And I'll manage the other couple of that way too. All right. No, I don't have like, yeah. Oh yeah, we do. Yes, absolutely. But not for, you know, like everything that we're talking about. Yeah, there are different handouts and things that you get, but to define them. But I talk about it all the time, and I do it while we're trading it, and I'll show you how to do it and how I do it. And other traders do as well. But I don't, because this is the thing about trading the opening range. There are oftentimes we've got different positions on. I might be long from a target, somebody might be long from a pay line, somebody else might be short from a bigger target on the upside. There are different ways of applying the same process, but the fundamentals never change, which keep fear out of my trading. Does this make sense? Or am I confusing too much? But yes, it is. But remember, there isn't, you know, there are things that you get, you know, handouts aren't the right thing, but there are things that you get, but you know, we're all at, and that's another thing. We are all at different places and different phases in our career. We all have different, we are all working on different things, you know, and many of us are at the beginning of just trying to decide. For traders that are working with me in one-on-one, it's amazing. You know, I've had a lot of traders come in like, all right, where's my textbook? You know, where's my manual here? There's no manual. You know, if anybody, you ever ask somebody a question about the market, you know, what are you going to do with this price? Or what? The answer should always be, it depends. Anybody that gives you a hard and fast answer about anything other than, you know, some fundamental truths is usually, you know, it's going to be too opinionated. It's going to be too biased. The answer should always be depends, because there are just too many variables that change from day to day, from second to second, from nanosecond to nanosecond. Jedi Marcus on Twitter is an old floor trader that I got to know years ago. When he and I reconnected, a couple years ago, because of my Twitter, when Jedi Marcus and I reconnected because of me, you know, coming out of the woodwork and starting to tweet to help my friend Kevin. I think Jimmy Jude or Anthony Credelli asked me if I was me, you know, from the, are you PAX from the NASDAQ? Yes, I am. And then, you know, then Jedi Marcus jumped in. So anyway, Jedi Marcus and I had breakfast, and he was astounded. He actually came back and he tweeted about it. I bookmarked the tweet. PAX is going to put on the same trade, and this is an important point to make. PAX is going to put on the same trade that he just got stopped out of a split second later for different reasons. The variables in the market can change nanosecond to nanosecond. So if I get stopped out at 26.25 and price comes back above 26.5, I'm not thinking. As long as I'm confident, carefree, fearless, and focused, I am going to execute without hesitation. And price comes back up above 26.5, I'm long again, because I trust myself to not overtrade it. I trust myself to not get stubborn. I trust myself to not veer away from my plan. So I'm going to take that same trade that I just got stopped out of, and that flabbergasted him, because, you know, the old standard of thinking is, if I got stopped out of a trade, well, I must be wrong. I must be on the wrong side. It must have been the wrong trade. I got stopped out. But that's not necessarily the case for me. Now, obviously, you know, that is true in many instances, but not in this instance. So the variables to the markets are going to change from minute to minute, second to second, and we're all at different spots or different stages in that progression of learning, and how to visualize the market, how to see who we are and all of it, how we apply ourselves to it. That when I'm working with traders in a one-on-one setting, it's always, I have to take you for where you are. I have to see your strengths and your weaknesses and help draw them out and help bring you through it, right? So there is no one size fits all. There's not, there are going to be the things that we talk about that are true for all of our trades. We have to know our outs. We have to know the 4 pillars of capital management. We have to know the 3 rules of engagement. You know, all of these things, 3 rules of engagement. If anybody hasn't seen that video, it's up on YouTube. You can go watch it in more detail. But it's just, you know, number 1, before we take the trade, we have to know our outs, right? That's the number 1 rule of engagement. Number 2, or rule of execution. Number 2 is going to be our matchups. That means a lot of different things, and that, you know, so go watch that video. And then that number 3 is going to be time frames. To Sherry's I think Sherry's gone, but to Sherry's question about, you know, do I do this on the reopen? Oh, hey, by the way, I don't trade overnight. I don't trade at any other time except for during regular trading hours. I want to trade I want to trade with the I want to trade with the algorithms, the HFTs and their algorithms doing the work for me, right? The way that I see, let me see if this makes a little sense and helps you guys see how I visualize. So all of these things help me. Again, I cannot tell you how important it is, and it seems to be making sense in my mind the way it's coming out. When I am able to see the market this way, then I am able to trade it confidently, carefree, fearlessly, and focused. Okay. If any of these things missing, then I have to cut my size. I have to, or I have to cut my my trades. I have to stop I have to cut my attempts, cut my size or cut my attempts, or not trade at all. Learn how to go big, go small, or not at all, right? All of these things all feed into one another. It's all related, all of it. And we all see the market differently, and we all react to it differently. We all have our own unique sets of abilities. We all have our own unique sets of skills, and we all have our own unique sets of fears. And that's what's going to kill us. But if you can see the market simply and you can react to it simply, then you're giving yourself more of a chance to be long-term successful. You're giving yourself a better opportunity to be a long-term profitable trader, because the odds are against you. You know, the old adage, you've heard me say this before, how do you make a small fortune trading futures? Start with a large one. Learn who you are. Where are you? Be honest, brutally honest with yourself. Oh, third rule of execution, timeframes. So I'm not going to trade, and at that, thank you. It was starting to get off base. I'm not going to trade at any other time out except during normal trading hours, because the algorithms, create the volume now. I want to trade during the most heavily traded times. I want to trade when there are matchups. When there are matchups, meaning just simple, the simple part of it. Where is this market in relation to that market, in relation to that market, and then the broader sense, the capital flows. Where is this sector against this sector or that sector? And I've got to notice all of those things instantaneously when I take the trade. No, not instantaneously. I have to notice those things after I pay for the trade and remove my risk. No, I'm sorry. I have to pay attention to those things after I minimize my risk and remove my risk. Then I'm going to start looking at the matchups. I'm not going to look at those things until after the market protects me. Nothing else matters. Nothing else matters. When I get long or I get short, nothing else matters until the market protects me. Then I put my stop in a hard stop. Nothing else matters at that point until I can remove my risk. Once I pay for my trade, then I need to notice the matchups. Then I need to go on and I need to see what the capital flows are doing. And again, matchups mean a lot of things. And even in that short video on YouTube, it's not going to completely tell the story, but it'll get the point across. No matter where you are in your trading, no matter where you are, no matter what instruments you trade, no matter how long you've been trading, what your experience levels are, we all have to know what our obstacles are, what is most likely going to pull us off of our center, what is most likely to start to pull us away from being who we truly, most authentically are, being the best version of ourselves. Traders in our group hear me saying that all the time. If we start to little techniques like removing our P&L, I don't trade my money. I can't trade, but I'm mindful of where I am, right? But I can't trade by looking up and seeing that number get greener or that number get redder. I'm trading the market as it is. I'm long at 26.75. I've got to remove my risk, pay for my trade, take a profit, right? All of those things. So it doesn't matter how complicated your trading is, simplify it so that you can just simply know the most important part of any trade. The more you grow in your awareness of price action, the more you grow in the awareness of the market, the less fear comes into play in your trading. The more you learn how to peak before the open. You cannot just come down and plop yourself in front of the screens right before the market opens. I talk about putting a socks hat, coming down in my sweats and putting a socks hat on backwards and just plopping down, because that's what I've done. And that doesn't work. For me, I fall into fear-based trading. I fall into outcome-based trading. I start trading money. I start trading all kinds of things except my plan. I'm more likely to freeze up. Have you guys ever had that experience where you've got a position on and the market's running against you and you're stuck, you're froze? I have. I know how that feels. And I've got little techniques that I use when, to keep me from that state of being, keep me from that state of mind. you know, or little techniques that I use when I have a series of expenses. Like I write down every trade, you know, just like when I trade, when I take a trade if I get long at 26.75, the second the market protects me, I write it down. Plus, you know, if I bought a 4 at 26.75, the second I pay for it, I put a minus, sell 1 at, you know, 46.75, whatever. Remove my risk. In the S&P, it's 4 points. 4 points above the top of the opening range, 4 points below the opening range, pay line. Okay. Then, I'm sorry, Olaf, what did you say? Anyway, then I can start to look at other factors, but it's always going to be the most important part of any trade, which is going to be to know your outs, and at that point you can take it, and the fear of oh, that's what I was talking about, little techniques. So if I take a couple of expenses, buy 26.5, sell 26, buy 26.5, sell 26 quarters, 25.75. I cut my size. If I'm not running down my trades, I'm more likely to keep flipping in and out, and to keep taking these expenses and not live in my 2x4, not cut my size after 2 attempts, right? I'm just going to keep going. I've got to be able to interrupt that behavior on the trading floor. If you guys have ever seen pictures of me trading, I had, you know, my trading cards in one hand, right? My hands up in the air. So I'm 100 and a half, 100 and a half, 40 on 50, 40 on 50. All right. If I wanted to make a trade, I had to do those things. Or at very least, if somebody was 40 bid, I sold. And I had to write it down on the trading card. And I had to give it to my clerk. I had to take action. The only thing I have to do on the screen is click, 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 click. Long, long, long. Remember the beginning of the story when I started to talk about how I had, my wife and I were looking for nickels, quarters, and dimes. That's because I sat on the screen just clicking away. I'm long 50. I'm only going to trade 20 lots. I'm long 20. I'm long 80. I'm long 100. I'm long 200. I'm only trading 20 lots, but now I'm long 200. How does that work? I'm not controlling my trading. My trading is controlling me. So I've had to learn how to disrupt that on the screens so that I stay within my lane. Now, depending on the market, obviously, I'm going to take more than 2 attempts before I cut my size, but it depends on, you know, my process within the process, me working towards knowing whether or not I am CCFF and how important that is for me. Okay, now, begin to lose fear. When money is in my eyes and I begin to lose fear, loss, begin to lose fear, loss that happens. Olaf, try to say that in different terms. So it's just on me to say it. When money is in my eyes and I begin to fear loss. Oh, that's what happened to me. Yeah. Okay. So, you know, if you're prone to freeze up, or you're prone to overtrade, or, you know, which I think we're all prone to at some point or another in different ways in different areas, you start to overtrade that money to make it back, or you start to become mindful of it. Just simply stand up. Stand up. Clap your hands. Say your name. Take in 3 deep breaths and sit back down. That's it. Get up, go make a pot of coffee. Go make warm up a cup of coffee, go make a pot of tea. Go for a walk. Guys, listen, the markets will be here. Markets will always be here. They always will. The point is are you going to be here for it? And I will end with this. And yesterday I was talking to a trader before I left Chicago, and we were sitting having breakfast outside. Great day, beautiful morning, great breakfast. Shooting at 600 South Wall Street, about 5 blocks from where we were. Anyway, we were talking about how we're traders, right? Not investors. So we're looking to whether you're an intraday trader or a swing trader or a position trader. The way that I manage my positions, there's the intraday part, there's a swing part, and there's a position part. You know, that's a longer conversation. That's why I trade in quarters, so that at the end of the day, my runner becomes a longer position that could become a swing or a longer term position depending on the market. Okay. All right. No matter what it is, we are going to have maybe every month we're going to have maybe 3 or 4 really good days that make our month. Everything else, is just extra. So let's say you're a micro trader. Every micro trader, if you're consistent anyway, if you've learned how to be consistent, you're going to have 1 or 2 days where you're going to make between 500 and 1,500 in the micros. You're going to have a few days where you're going to do that every month. Then everything else in between that is meant to, 50 here, 100 there, 80 here, 60 here, right? And now those 3 or 4 days, 5 days every month, depending on the volatility that's going to come and give you those $500, $800, $1,000 days, and obviously times that by 10 if you're trading minis. Every quarter, you're going to have a few weeks of, or every month, you're going to have maybe a week, 4 or 5 days. Every quarter, you're going to have like maybe 4 or 5 weeks of those days put together. Every quarter, you'll have, depending on volatility, obviously last year was different, and we'll get to that too. So everything else is just meant to protect you every day. Because guys, none of us know when the market's going to roll over and take out some really important lows, or when it's going to, continue to climb and go parabolic. We can only guess, but nobody knows for sure. Nobody knew when we rolled over in September, and in February of 2020, when the NASDAQ or the S&P set the all-time high at 33.97.5. Nobody knew that opening range was going to be the all-time high opening range, and that became a career-making trade for many of us. Okay, the opening range that day was 33.80.5. Our first target was 33.69. How do I remember that so clearly? Because I was short from those days. So every month we're going to have 4 or 5 days that make our month. Every quarter we're going to have 4 or 5 weeks that make our quarter, depending on volatility. Every year we might have 2 months of those really big days, collectively, right? And every other day is just a matter of protecting ourselves, not giving into outcome fear-based trading, learning how to maximize our profitability and minimize our risk by learning how to, the 2 parts to every trade, 3 rules of engagement, 4 pillars of capital management, knowing our outs before we take any trade. All of those things give us the opportunity to take advantage of the price action when it's there in front of us. Every trader is going to have a 2 or 3 or 4, 5 or 6, if we're lucky, career-making trades. And by that I mean, catching it from the 33.80.5 to 22.80. Those huge moves that just seem to be made for you. And you're peaking with it. You're right in the middle of it. You're feeling it. You're executing without hesitancy. You're executing without fear. You're executing confidently. You're adding, you're doing everything well. It just seems like it's made for you. And maybe that career-making trade is a year or 2 or 3 years off. Maybe you're in the lane of just learning how to stop the hemorrhaging and you're learning how to break even. If that's where you are, then live in it, appreciate it, love it, be satisfied with it. Not happy, but be satisfied that that's where you are. And don't try to do too much too fast. Give the market time, give time. Come in every day with the sure and steadfast belief that you're going to have a positive trading day every day. Also, it's not always going to happen, obviously, but you believe that you're going to make that happen. You believe that you're going to stay out of the way of the market. You're going to let that groundswell become a wave and you're going to catch it. Employing or deploying the tactics and the fundamental truths that we've talked about today. But also come to the markets every single morning knowing that you're going to have to spend a certain amount of money to make money. Every morning you're going to have to spend money to make money, and that just is the case. And you're okay with it because you know that as long as you stick with it, you're going to move from the roller coaster part where you're constantly putting money into your account or consistently putting money into your account to the break-even part. And then you're going to appreciate that. You're going to work to push forward, but you're not going to do it too quickly. When you become profitable, you're going to relish that. You're going to be satisfied with that. You're going to continue to learn so that you can become ultimately profitable by learning how to add to your positions. properly without significantly adding to your risk. All of those things are possible. It's difficult, but possible. You guys, if any of you ever heard me talk in any of these videos before, you've heard me say this before. If I can do this, you can do this. Again, I'm not a dumb guy. I'm not but I'm no genius. This process makes me look a lot smarter than what I am. Sometimes circumstances make us look smarter than what we are. I developed this process over a long period of time using my experience and my knowledge of the markets and technical analysis. And I've learned how to keep things simple and to, keep things repeatable and scalable, because I need things simple and I need it to be repeatable. Any questions at all? I hope that there was something here tonight that resonated with you. I hope I made sense. I know that I have a tendency to kind of be all over the place, and if I was, I apologize for that. But I usually try to come back and use those little things to tell stories or to illustrate a point. Any questions about what it was like on the floor, or anything like that? Any of the funny, goofy stuff? You guys ever see Floored? You saw the movie Floored? Any questions about that? Great, Olaf. I'm glad. Thank you. And Olaf, I'm sorry. I meant to actually. I was going to say this on Twitter earlier when you responded. I'm sorry. On Twitter, I haven't been real active. My wife has been seriously ill. Remember I had COVID back in November. My father died of it. Then just many other health issues besides my eye, and beginning to hopefully not losing sight in it. But my wife was hospitalized for over a week, just as soon as my eye gets better. And then when she got out of the hospital, I started golfing again. I started running and working out again. Exercise, very important to me. On the trading floor, I smoke my brains out. Always smoking. On the trading, off the floor, I guess we can talk about that at a later date. But my process that I started to put together to get into my process, my morning routine, that's another thing. All kind of happened because of the circumstances in my life. I was trying to learn, how to apply these techniques, and I was trying to figure out what worked. So I was getting up to trade European Open. So now I'm up in the middle of the night smoking away. So I started to pray rosary in the middle of the night. And then that led me to meditating. And, then I started to work out at 5, 6 in the morning when I stopped trading. All of these things then kind of shrunk into, an effective routine. Anyway, okay. I want to end on that. I'll let you please. Hey, listen, I'll answer any questions any of you have. I've been talking for, of course, too long. But if there was anything that you wanted me to expound on or get back to or anything, just let me know. All right. So, this is really trading. Long-term trading is very difficult, but really understand that we're all going from, every day is not going to be the day that you're going to get rich. You don't need to try to make your fortune tomorrow. Tomorrow's not the day for any of us to try to do anything. Remember, we've got summer markets ahead of us. There will be volatility. And also, there is plenty of opportunity to make money in 15-handle ranges. As long as we make the necessary adjustments to the way that we trade. That was very difficult for me for a very long time. It took me a long time to learn how to trade in order to make those, in order to be able to make those adjustments. So MK's question is, can I touch on exploiting profits? I don't know, maybe exploiting isn't the right word, but it's just something that came out one day, and so I just continue to use it. But the most important part about learning how to exploit your profit is that you're going to use that existing profit that you've got locked in. Okay, so let's just use this 26, and we'll use 26.5 as 24 to 26.5 as the opening range in the S&P, and we'll use the downside this time to mix it up. I'm short at 24. 4 points below the opening range is my pay line. I paid for that trade. So I protected myself. I minimized my risk by putting a stop in at 25 or 24.75, 25, 24 app maybe. So as soon as 24s go off for 23s, I get a point into the trade. The market's protecting me, hard stop in, pay for the trade at 21. I quickly changed my hard stop to reflect my new quantity to a 3 lot. Then I go ahead and I look at where are my targets. Ooh, I've got a target down here at 42.08. Well, I'm not going to trade between 42.20 and 42.08. I'm going to let the market get there. When the market gets there, or if the market gets there, I'm going to take profit. Now, in between, anyway, yeah, I don't want to get too far into the plan. Okay, now, underneath 41.94, that's my next target. I'm going to take profit at 42. You know, I took profit at 42.08. Now I've got 2 contracts on. I got half my unit on. Okay. Now we get down to 41.94. I know I'm going to be taking profit there. We get down there, but I also know that if we take out 41.94, because 41.94 is a big target. It's not a big target in my mind. Actually it is, but you know, I'm just saying that if the market's rolling over now, you know, nobody knows it's summer markets. Nobody's expecting it to. Here we go. But now, hey, somebody else decides that they're going to push it lower. So we take it out. I'm taking profit at 94, but my targets are always 2 points wide. Market gets below 92 the very first time. Okay, now I've got all of this profit locked in. I'm short my runner. Okay. The very first time through that target, I'm going to sell something. Let's just in this case, I'm going to say that I'm going to sell that part of my unit that I took off. So I'm short 2. We get down there. I buy 1 in. That makes me short my runner now. We get below 92. I'm going to sell 1 at 92 right away. Now I'm back to being short 2. Actually, the way that I trade, I'm going to sell a whole nother unit down there. So I'm going to sell, if I'm trading 4 lot units, I'm going to sell a 4 lot at 92. Now I'm short 5. And what's my risk being short 5? It's the same as being short 1, because if we go 92 bid, I'm out. It's really important to understand that this either works right away or it doesn't. So I'm going to sell those 92s. They go 92 bid, I'm out. They go 92 offer, 91 offer, 90 offer. Hell yeah. How many times have we seen the market roll over like that and you've got nothing on and you've already exited your trade at 42 even on, and now you're giving back all kinds of profit, if not all of it, by trying to reinitiate that trade. Has anybody done that before? You know, you were short from 42.24. We get down to 42.12. You flatten up. We get to 42 even. You try to put them back on. Chops you up. You give back half of what you made. We get down to 41.94. Damn. You try to sell them there. Back up. Now you're buying them back at 42 even. Now you're getting long at 42 even. Now you're selling those at 91.94. You're selling them again at getting short down there. Now you gave back all that damn money you made. Now what? Now you're hoping that market really goes. Then the market rolls over. Now you get lucky. You make your money back, and it becomes about luck. Oh, I hate that expression. Oh God, I hate that when people say, "I'd rather be lucky than good." I've been on the other side about every outlier I can possibly have been on in my career, and I'd rather be good, because I know that I'll be okay. Anyway, now we've all had that experience, or many of us have. So, but here's the thing, okay? Because this is either going to work or it's not. So I'm going to trade one target to the next target. So pay line, target 42.08. We get down to 42 even. I might be looking, if 42 even holds, you know, I might be looking to take profit, but that's not a target for me. 41.94 in this example. 41.94. I'll call 42 even a price point, but 41.94 will be a target. We take out 41.92 when I'm either going to sell that unit back, or I'm going to sell that part of unit, 1 lot, or I'm going to sell a full unit, because I know that if we go 92 bid, I'm out, but I'm still short 1 from, you know, from the opening range. So if the market goes from 92 back up to 42 even, and 42.04 back down to 41.98, and then bounces around there all damn day long until the last hour of the day, and then boom, it rolls over. Well, I'll take another shot there. But I'm always going to do it on that first time down through the target if there's momentum on it anyway. Not always, if there's momentum. If my matchups, back to the 3 rules of engagement, if my matchups are matching up and if I have other indications that this market might try to roll over, because again, nobody ever knows, nobody knows for sure. So I am always going to try to let the market tell me what it's going to do. And I'm going to try to position myself accordingly. So again, I take profit at 94 and I'm short 1. We get under 92. I sell 5 or I sell 4. I'm short 5. And the market continues to roll over. I'm going to pay for that trade someplace. It's no longer 4 points. 4 points is only from the opening range. I'll pay for it depending on momentum at 89 or 90 or sometimes, my God, we've had a lot of trades just this year alone from 39.12, which was a major target for us in December. From 39.12, we did this, I think, like 3 or 4 times. We went from 39.12 down to 37.48, the yearly opening range, down to 37.26, another target of ours on the downside, a few times. So when we get through these targets, I'm going to add the first step. Now here, there are other techniques to doing this at targets MK, to exploiting our profit. There's other techniques, and I can get into them for hours on end, but so that's that's kind of does that answer your question in a way? Because it's difficult. That's a really great question, and it's also very involved. I mean, there's a lot to it, but that's just, hopefully that gives you somewhat of a visual. Or did I muddy the water? Did I make it more confusing? Hold on, I want to get to hold on some more. We can talk about that tomorrow. Are your levels that you use good until broken? No. No. So no. Shit. Yeah, Michael, are you still here? Michael P. Are you still here, or did you skedaddle? It's a good question, and I want to kind of answer that if you're here. Are your levels that you use? Okay. No. All right. He's not. Well, let me try to answer it.
Still listening here.
Huh? What, Adam or Pedro? Who was that?
I said he's still listed in here.
All right. Are your levels that you use good until broken? No, they become another target. So if in this instance, so I'm short 42. I'm short from 42.24. I've got I pay for the trade at 42.20. I don't have a target until we get down to 08. Now, obviously, with these tighter markets, with these tighter ranges, my targets are like on top of one another. But more volatile markets are going to be further away. Anyway, hold on. Oh, wait, with that other question, put that in there. I wanted to answer that. That was a good one too. Somebody deleted it.
That we can find an accommodation that where we can save the lives.
And can you mute out, please? Thank you. All right. So anyway, no, my targets are good. My targets stay targets. My targets, the market has memory. The market is going to remember, the market will always remember certain targets. I don't use support and resistance levels. I don't think of my targets in terms of support and resistance. It's a great question, but a little bit more involved. There was another question too that somebody had asked, but they removed it. So Sambor, I'll just say, repeat the 3 rules of engagement. Is it's just the most important one is going to be risk definition. Number 1 is risk definition, and again, there's a video on YouTube, Sambor, that I under the PAX Group YouTube channel, so you can go back and listen to it. It says 3 rules of engagement. Number 1 is our risk definition. Where is our outs? Number 2 is our matchups. And number 3 is our time frames. I wish Michael was still here. All right, any other questions? Oh shit, I'm sorry, I missed it. All right, you trade less at contract rollover. Yes, I'm sorry, that's what I wanted to ask. So algo tip, I barely trade at rollover, barely, hardly ever. I hate rollover. Now in equities, gold rolls more often. Crude is always rolling, and energies are rolling every 2 weeks. So, that doesn't come so much into play, but in the equities, I mean, I really haven't traded the equity. I haven't traded rollover except All right, let me just explain how. You know what? Oh, you guys know what rollover is? Does anybody not know what rollover is? Well, all right, I'll just explain it anyway. A brief overview. So each futures contract has a contract month, right? So like in cattle, they're going to be, the months are going to be different than what they are in the currencies. They're going to be different than what they are in equities. They're going to be different than what they are in the energies. Energies are every month because they're deliverable every month. Cattle is going to be deliverable seasonally. So you've got seasonal contracts, right? The equities are seasonal also, but quarterly. It's going to, so you're going to have March, you know, hand signals are like that. March, September, let me go and do let me just go in order. September, December, March, June, March, June, right? Am I missing one? Yeah, quarterly. So the last 2 weeks of the contract, I don't trade it because the market trades differently. Open interest is going from, right now, open interest is going from the June contract into the September contract. Then June expires on Friday. So it's not about the price action. It's about the open interest, which is, I think the open interest the other day when I looked at it was like 2.5 million. Open interest is the amount of open contracts. I mean, open positions. So if I go home short one, I add 1 to the open interest. If I go home long 10, I add 10 to the open interest. At one point, and for an extended period of time in the NASDAQ, I was about 10% of the daily volume. You know, have you guys ever heard me talk about, does anybody know who Navinder Sareo is? Has anybody read that book by Liam Vaughn? I forget the name of the book again. Talks about NAV. Does anybody ever not heard me talk about him? You know, at one point I was about 10 flash crash. Thanks, Simba. I was about 10% of the daily volume in the NASDAQ by myself, and I could move the NASDAQ 100 points by myself if I wanted to. I mean, you know, legit. I mean, I'm not kidding. But when the market changed, I didn't change with it. Oh, that's another thing though, is I was about 10% of the volume. That made me a big trader. Margie Teller in the Eurodollars was 10% of the open interest. That made her a big player. I was a big trader. She was bigger than the banks. I may have traded more than the banks, but they were, you know, they were the difference between volume and open interest. Volume is what you can trade during the day and get in and out of, right? Open interest is what you carry overnight, how many positions you carry. You know, somebody like Margie Teller was, God, Margie was just a phenom to watch. A wonderful woman, great trader, biggest futures trader in history. Nobody bigger. Maybe bigger size during the day, but no, not a chance. She was 10% of the open interest. There was no way that anybody could come up with that, right? So open interest is the amount of open positions, and those open positions have to roll so that they can stay on. That's again why I don't consider myself a technical analyst, although I guess I am in a sense, but and I do pay attention to order flow. My targets are based on my targets are based on, you know, I guess just a proprietary, you know, formula that I was taught years ago. There aren't too many traders that know. There aren't actually too many traders that know how to do this. And, that know how to target out the markets that I do. The way that I was taught. Anyway, I don't know. You know, I didn't invent it. Shit. Nobody invented anything, you know, even the process that I put together from bits and pieces from my experience through the years. Anyway, I was taught through my mentor, Judd, how to do them years ago. And, you know, continually in the last few years too. But, you know, Ira Harris and others, it's a proprietary way of learning how to do it. And order flow, you know, as I was talking about earlier when I traded for Stottlemyre, you know, when he was trying to update market profile to bring it into the age of algorithms, one of the things that Stottlemyre said, and I believe it's public, you have to look for it, but market profile stopped being an effective, how do you put it, an effective trading methodology. Market profile stopped being an effective trading methodology when algorithms became the generator of the majority of the volume, in, I think in 2003. Market profile, I still use profile and you know, other parts of it to set the market in a context on a daily basis, but I don't make trading decisions based off of it. Others do now, because you know, that doesn't mean that it doesn't work for them, you know. Anyway, I trade off of the domes. I don't trade off of charts. I don't look at charts during the day unless I'm trying to get a feel for where the price action was when I wasn't in front of the screens. You know, I'm not drawing charts. I am not drawing lines on a chart during the trading day. There are certain things that I pay attention to during the day, like point and figure charts. I do look at those for the reversals in more volatile times, but we haven't had a reversal in you know, a month since, you know, and when we did have reversals, I was blind in my left eye. I couldn't see anything, so I wasn't trading. Anyway, you know, all of this is, there's just going back to it. There are a lot of different ways to visualize the market. And what works for you, as long as it's simple and it's repeatable and it's scalable and it's consistently profitable, that works for you. But the fundamental reality of all of that has to remain the same. You have to know your outs before you take a trade. You have to know, if you know your outs before you take your trade, then you can deal with the fears that come about. Then you can start to move from managing the first part of your trade, from managing your risk into managing your profit. And then you can take that profit and you can learn how to use that profit to generate more without generating too much risk. And by that, I mean selling, you know, 42 evens, buying 4208s, selling 4194s, and back and forth in the noise and getting caught up in the algo chop, as opposed to just trading from one target to the next and staying out of that chop, waiting for the market to tell you whether it's going to extend or not. This is possible, but it's incredibly difficult. You can do it. If I can, you can. You know, and even my even if the odds are stacked against me too, you know, past results are truly not going to be indicative of future results, because the variables change constantly. But as long as you hold on to these fundamental truths and your fear dissipates, and you continue to grow in your vision of the market, you continue to grow in how you see and how you execute, and you become more proficient at executing in and out without hesitancy and confidently and clearly, then you're going to tilt the odds in your favor. Then you can become, you know, part of that 10 that will see some profit. And then you can work towards becoming that 1 or 2 out of the 100 that ultimately become ultimately successful. So is there anything else that I can answer for you guys? Well, I hope that there was something here that you had that had resonated with you. I hope there was something here that you guys said that you had got something out of this. You know, trading futures is just an incredible. Every time I see, or every time I saw Leo Melamed, I thank him, and you know, yeah, I've tweeted about that before, and I talked about it. You know, is when Leo Melamed, whenever I would see him, I would say, "Thank you, Leo. Thank you, Leo. Thank you, Leo." Finally, I was over at his house. I became very good friends with his son Jordy, and I was over at his house, and Jordy had Leo had come over and said, "Pax, why do you thank me every time I see you?" I said, "Geez, Leo, I grew up on the south side of Chicago. I went to school to study to be a Catholic priest. I didn't know, who knows what the hell I'd be doing if it wasn't for this exchange that you've created, for these suite of products that I trade, that you created along with people like Milton Friedman, Ira Harris, Jack Sainer, all of the people that continue to build the futures industry to what it was after the breakdown of Bretton Woods." I mean, you go ahead and get Leo's book and read it. It's an incredible gift to be here. It's a great gift to be here with you guys tonight. I know that I said that I do one of these at least once a month, and it's been a couple of months because of my health and my wife's health. So I just want to say thanks for being here and sharing your Sunday evening with me. I hope I did earn the privilege of your time. I love this job. I love trading. I love talking about it. I love doing it. I love everything about it. I love teaching it. I love all of it. So everybody have a great night. And as I say every day when we hang up and we get out of there, as my mom used to say, sleep with the angels and all the saints. And nobody fights alone.